Good morning, everyone, and welcome to today's presentation on discovering 1031 Exchange. My name is Jeff Stechmann. I'm the Eastern Regional Manager for Asset Exchange Company. Before we kind of dive in today, I just wanted to let everybody know today's presentation is being recorded. So don't feel like you have to write every single thing down. You'll receive a link to today's recording if you want to refer back to any of the topics that we're going to discuss. And also some of the topics that we're going to cover, I have in just like single page PDF form. I'm going to email those out to everyone because I find a lot of times if you have a client that has a 1031 exchange need, you really would love to be able to send them something via email. And what I send you with those, the email that I send you along with the PDFs, you can pick and choose which PDFs apply to your client. And if you wanted to include me on the email where I can follow up with any questions, that would be great as well. But just be on the lookout for those after today's class. And then, as far as questions go, I'm going to open the floor up to questions at the very end of the presentation because I find a lot of times if you do have a question, most often it's going to be answered in an upcoming slide. But if for some reason it isn't, then again, at the very end is when we'll open the floor up to questions. And today's presentation is actually worth 2 hours of continuing education for Florida realtors. So if you are a Florida realtor, when you registered, hopefully you gave me your correct license number, including the SL or the BK, because I have to manually take your first and last name and upload along with your license number, including the SL or BK. I have to manually upload it to the state of Florida in order for you to get the 2 hours of continuing ed. And because it's a 2 hour continuing ed class, you have to participate or you have to stay on the line for the entire duration of the class. If for some reason you're unable to attend the entire class, unfortunately, I'm going to be unable to give you those 2 hours of continuing ed. The state requires you attend the entire class. It's nothing, it's not my policy, but it's the state of Florida's policy as far as continuing education go. All right, so let me just kind of give you a little bit of background about myself. So this is actually my 27th year in the business. I did a lot on the title side of the business to get my start. I'm originally from New Orleans, so if you hear the accent come through, please forgive me. Every now and then it rears its ugly head, but I'm actually based out of Tampa, Florida. I've lived in Florida for 24 out of those 27 years, and as long as I've been doing this, I've seen the really good times in the real estate industry, and boy, I've seen the really bad times too. And right now the industry is just booming. I mean, last year was a record year, and hopefully we can keep it up, keep this pace up for the remainder of this year. But time will tell, I guess, to see if the pace can be kept, or we can maybe at least equal what we did last year. So let me give y'all some information about the company. Whoops, sorry. Again, we're Asset Exchange Company, and we've actually been in business since 2006. And over the course of our existence, we've done about 40,000 1031 exchanges. So it's all that we do. All right. We don't provide any type of closing services, escrow services. We don't provide any type of financial services. In the industry, we're known as a qualified intermediary, QI for short. Now, depending on the area of the country that you live in, you may hear people referred to as an accommodator. Another common term is a facilitator, or just simply an intermediary. But most often, people just call us QIs. All right. Now, our main job in a 1031 exchange is we actually hold the proceeds from what we refer to as the relinquished property. So that's the property that's being sold in a 1031 exchange. Now, we hold those proceeds on behalf of the seller, the exchanger, right? Because the rule is they can never actually have receipt of those funds, okay? If they do, they would actually lose their ability to do a 1031 exchange. And we're going to talk about that in more detail in some upcoming slides. But just a word of caution to everyone on the line today. It's amazing in today's heavily regulated real estate industry that, at least on a federal level, there actually is no federal agency that oversees what we do. So, what exactly does that mean? Well, what that means is anybody out there can be a QI. Okay, there's no type of requirements you have to have any type of E&O insurance. There's no type of requirements you have to have any type of bond. There's no guidelines on where you hold the proceeds or the type of funds you hold the proceeds in. It's a really scary thought when you sit down and think about it. So, just if anybody on the line today is currently involved with a 1031 exchange, please just make sure you've done your due diligence and you're dealing with a reputable company. All right. Now, great news when you deal with us, right? We're actually based out of California. Our home office is in San Francisco. And because we're California based, the state of California actually has a state agency referred to as the California Franchise Tax Board. Now, that Franchise Tax Board actually oversees qualified intermediaries in the state of California. Okay, they do require us to carry minimums for the E&O insurance. We have minimums for the bond that we carry. We're subject to audit by that Franchise Tax Board. There's guidelines on the financial institutions where we hold the proceeds, the type of funds we hold the proceeds in, which is great for anybody that deals with us in California, right? But anything that we do, any exchanges that we handle in any part of the country, because we handle 1031 exchanges all throughout the United States. Well, that Franchise Tax Board has oversight in any file that we work on, okay? Not just California property, but any file that we work on, because, as I mentioned, they could come into our office at a moment's notice and audit any of the files that we work on. So, you do have some assurances when you deal with us. And then as far as our ownership goes, we're owned by two gentlemen. Now, they've been in the 1031 exchange business specifically for over 20 years, one of which is actually a tax attorney. Now, his name is Adam Skarsgård. Now, Adam is actually considered like a 1031 exchange expert. He's been called upon to testify in tax court as an expert witness on 1031 exchange. He even occasionally teaches at UC Berkeley on real estate and tax law, that type of thing. The whole reason I like to bring his name up is because, one of the things that we offer that I don't know of any QI in the business offers, if any of the exchanges that we're involved with, if for some reason they were to get audited, well, we would provide free audit support. All right, we work hand in hand with the client's CPA, helping to defend the audit, and it primarily would be done by our tax attorney owner, all right, Adam Skarsgård. So another great reason to deal with us. Now, let's talk a little bit about the history of exchanging. So, believe it or not, exchanging has been around to close to 100 years. All right, it really started back in the 20s, and back in those days, exchanging was pretty simple. The way they handled it, maybe I had a farm that I grew corn, and I knew another farmer that he had a farm that he grew wheat. Well, I wanted his farm, and he wanted my farm. So all we did is just swap farms, and it was really that simple back in those days. But our modern day exchange, kind of the format that we follow today, that was really started back in 1979, right? And there was a gentleman by the name of T.J. Starker. Now, Mr. Starker lived in California. He owned all this land in California with timber on it, right? What Mr. Starker did was he sold that land to a timber company called Crown Zellback. All right, what Crown Zellback did is in exchange for the land, they gave him what was actually referred to as exchange credits. All right, and what Mr. Starker did was over the course of the next few years, he went out and bought various properties with those exchange credits. And that's really kind of how our modern day exchanges started back in 1979 with T.J. Starker. All right, now, if anybody on the line has ever heard of the term a Starker exchange, all right, well, that's where it comes from. It comes from T.J. Starker's last name. I talked to some CPAs, they've been in the business, 40, 50 years, and they still refer to a 1031 exchange as a Starker exchange. So again, if you ever hear that term pop up, that's where it comes from, T.J. Starker's last name. Now, when we talk about 1031 tax-deferred exchange, okay, that name is actually derived from Internal Revenue Code Section 1031. All right, and the code states this: no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment. Now, I know that's kind of a mouthful, right? Well, where the code states that property held for productive use in a trade or business. So you can do a 1031 exchange on any type of real property that you use in your trade or business. All right, I'll give you guys an example of maybe the way that could work. Now, we did an exchange for a gentleman. He owned a daycare center, okay? So he was using that real property for his business, right? So he sold it in a 1031 exchange, and in his case, he went out and bought another daycare center. Because why? Because he was going to use that real property for his business, okay? So any type of real property that you use in your trade or business, you can sell it in a 1031 exchange, and you can replace it with any other type of real property that you use in your trade or business. Now, the next part of the code where it says for investment, now for investment, that could be something as simple as, let's say you own a single family residential home and you hold it for investment. Now, how do you hold it for investment? Well, it's a rental property, right? Well, you can take that rental property, sell that rental property in a 1031 exchange, and then what can you buy as your replacement? Well, that's the next part of the code, like-kind property. So what exactly is like-kind property? Well, like-kind property is any type of real property that you use in your trade or business or that you hold for investment. You can sell that in a 1031 exchange, and you can replace it with any other type of like-kind property, which is any type of real property that you use in your trade or business or that you hold for investment, right? So just because you're selling that single family residential home that you hold for investment, that rental property, right? When you sell that in a 1031 exchange, you don't have to replace it with another single family, all right? If you don't want to. Now you can by all means, but you could even replace it with a duplex, a fourplex, a condo, a townhome, vacant land. Hey, you want to replace it with a commercial strip shopping center. You could replace it with a downtown commercial office building, right, in any major metropolitan area in the United States, right? One of the high rises, anything. It doesn't matter if it's residential or commercial to residential. Everything is interchangeable with 1031 exchange, right? It doesn't even matter if it's property that you use in your trade or business. You could sell that and you could buy investment property and vice versa, right? You're not even limited geographically where you can buy and sell real property, all right? You can buy and sell real property anywhere in the United States, including Guam, the U.S. Virgin Islands, or the Mariana Islands, all right? Now, sometimes people will ask me, they say, well, what about property in Puerto Rico? Can I use that in a 1031 exchange? And the answer is no, all right? Because I think Puerto Rico is under a different tax structure than we are here in the States, and that's why property in Puerto Rico is excluded from 1031 exchange, all right? Now, if anybody on the line has ever heard of the term a like-kind exchange, well, that's where it comes from. It comes from that part of the code that talks about like-kind property. Now, here in Florida, realtors here in Florida, our standard real estate contract is referred to as the FAR bar contract, right? There's already 1031 exchange language built into that contract. All right, it's in section 18, it's item N in section 18. In the real estate contracts here in Florida, they actually refer to a 1031 exchange as a like-kind exchange, right? So again, if you ever hear that term pop up, that's where it's coming from, the part of the code that talks about like-kind property, all right? Now, why do investors exchange? You know, well, the single most obvious reason is for tax deferment. So typically when you sell real property, okay, if you have any gain in the property, now on average, okay, on average, about a third of whatever that gain is goes towards paying taxes. And that's the single most reason that we see investors doing 1031 exchanges is to defer those taxes. But what are some of the other things that we see? Well, the next bullet item, I call it buy more property. So with 1031 exchange, one of the rules to exchanging is the replacement property that you purchase in a 1031 exchange, that purchase price must be either equal to or greater than whatever the sales price was on the property that you sold, right? So what an investor will do is by utilizing the tax savings of a 1031 exchange, where no longer do they have to cut that check for the taxes, they utilize that as leverage to go out and buy themselves a better property. hey, hopefully it's going to be a higher dollar property, and also hopefully it's going to be a higher income producing property for them as well. Okay, now, what are some of the other things that we see? Well, diversification and management relief is another thing that we see investors utilizing 1031 exchange for. You know, with exchanging, you're not even limited to how many properties you can sell in an exchange, and you're not limited to how many properties you can purchase in a 1031 exchange, right? You could sell one, you could buy one, all right? You could sell one, you could buy multiple properties. You could sell multiple properties and buy a single or buy multiple. It doesn't matter, right? But what does matter? I'll say it again. Whatever you're selling has to be real property that you use in your trade or business or you hold for investment, and you got to replace it with real property that either you're using your trade or business or that you hold for investment. All right, so geographic diversification is something that we see. I'll give you guys an example of maybe the way that could work. Let's say I own an investment property. Let's say it's located in California. Now, California has some of the highest property values in the entire country. Right? Where our home office is in San Francisco, I want to say the average sales price for property in San Francisco has now actually exceeded the average sales price for property in New York. All right, so you own that investment property in California, right? Now, you do a 1031 exchange, okay, but the replacement property that you purchase, instead of buying a replacement property in California, you say, well, you know what? Maybe I'll buy a replacement property, let's say here in Florida. Maybe I'll buy an additional property, maybe let's say somewhere in Texas. And I don't know, if you have enough, maybe you can buy another replacement property, an additional replacement property, let's say somewhere in maybe like Ohio, okay? Because why? Because you don't want to be so geographically tied in to one particular real estate market because, hey, who knows? If our market here in Florida starts to go down again, well, at least you have that other property in Texas and that additional property in Ohio. Hopefully those markets would not be experiencing the same downturn that we would be experiencing here in Florida, all right? Now, management relief is something else that we see investors utilizing 1031 exchange for. Give you guys another example. I have a client, he lives in New York. Okay, now he owns four rental properties in New York. Now, his ultimate goal is he'd like to retire and he'd like to move to Florida. But you know what? He doesn't want to manage property anymore. So what he would like to do is he'd like to sell all four of those rental properties in one 1031 exchange. And the replacement property that he purchases, he'd like to maybe find like a small apartment complex somewhere here in Florida that has some on-site management, right? Because again, why? Because he doesn't want to manage property anymore. He basically wants to retire and he just wants to collect a check every month. Well, you know, 1031 exchange is perfect for somebody like him because he seeks that management relief. Now, another thing that 1031 exchange is utilized for with investors is investors will actually use 1031 exchange as an estate planning tool. Now, this is a really great aspect of 1031 exchange, and honestly, it doesn't really get talked about that often. You know, it's if you don't remember anything from today's class, remember this next point, okay? Now, with 1031 exchange, you're not even limited to how many times you can do a 1031 exchange, okay? You could buy an investment property today, hold on to it for a period of years, at some point sell it in a 1031 exchange, defer your taxes, buy a replacement investment property, hold on to that for a period of years, at some point sell that in a 1031 exchange, defer your taxes again, and buy another replacement investment property. You can keep doing that over and over and over through the entire course of your lifetime, okay? Now, when you die, if you have any heirs that inherit your property, your heirs are going to get a benefit that's referred to as a step up in basis. And basically what that means is whatever the value of the property is when they inherit it, that's their basis, that's their starting point, okay? All of those deferrals that would have been done over the course of the lifetime from the individual that they inherited the property from, basically they go away and no one ever has to pay the taxes. All right, so again, it doesn't really get talked about that often, but it's really a great aspect of 1031 exchange, the whole step up in basis, right? That step up in basis is the person that inherits the property, the heir, that's their starting point, right? That's their basis. Now, What's the flip side of that equation? Well, I just mentioned you're not limited to how many times you can do a 1031 exchange, right? Buy an investment property today, hold on to it for a period of years, sell it in a 1031 exchange, defer your taxes, buy a replacement investment property, right? Hold on to that for a period of years, sell that in a 1031 exchange, and buy another replacement investment property. But let's just say the next time you go to sell, you say, you know what? I don't have any desire to purchase any more investment properties. I'm not going to do a 1031 exchange. I'm just going to cash out and pay whatever taxes are due. Well, you're going to be subject to taxes, whatever the taxes are on that transaction. And all of those previous 1031 exchanges that you did that you deferred your taxes, you could also possibly be subject to having to pay those taxes as well. All right, because with 1031 exchange, it's not a tax avoidance, folks. It's a tax deferral. Deferral meaning that if you do not continue to do 1031 exchanges, you may be subject to having to pay all those taxes. But remember the step up in basis, right? If you have heirs that inherit your property, they're going to get that step up in basis, and hopefully no one ever has to pay the taxes. So again, please, everybody remember that. Remember this aspect of a 1031 exchange with the step up in basis from today's presentation, all right? Here's a quick example of how the step up in basis could even work, all right? Let's say I'm the heir, right? I inherit that property. Now, for me, for my own personal investment purposes, right, I get the step up in basis. I'm not responsible for paying the taxes, right? They go away. Now, I may look at that property and say, gosh, this is a great property. You know, it's an investment property, a rental property, right? Maybe it has some nice cash flow coming in every month. I may say, you know what, I'm not going to sell the property. I'm going to hold on to it for my own personal investment purposes. Now, let's just say I hold on to that property for, I don't know, 5 years, okay? And then after 5 years, I may say, okay, now I'm ready to sell it. Now, if I have any gain from when I got that step up in basis when I inherited the property to when I go to sell it 5 years later, guess what? I can do my own 1031 exchange, defer my taxes, and basically start the whole process over again. All right, so again, hopefully everybody remembers the step up in basis and utilizing 1031 exchange as an estate planning tool. All right, now, what are current tax rates? Well, when you sell real property, all right, if you have any gain in the property, you're going to be subject to capital gains tax. Now, capital gains tax right now is either 15% or 20%. Now, historically, the 15% capital gains tax rate was applied if you were single and you had income of less than $400,000 a year, or if you were married and you had income of less than $450,000 a year, right? That's where you're at the 15% capital gains tax rate. Now, the 20% capital gains tax rate historically was applied if you were single and you had income of greater than $400,000 a year, or if you were married and you had income of greater than $450,000 a year. The reason I say historic is because the income levels have risen just a bit when they passed the last tax reform bill a few years ago, but still, any way that you look at it, you're still going to be subject to either 15% or 20% capital gains tax. All right. Now, on top of that, you also would be subject to what they refer to as depreciation recapture tax. Now, that's an additional 25% tax. Now, you may be asking yourself, how does that work, right? Well, the depreciation recapture tax works like this. Any depreciation that you've claimed, right, for the entire lifetime that you've owned the property, when you go to sell that property, they're going to hit you with a 25% depreciation recapture tax for the entire amount of depreciation that you've claimed for the lifetime that you've owned the property, right? Now, on top of that, you may also be subject to what they refer to as the Medicare tax, right? That's an additional 3.8% tax. Now, how does that work, right? Well, the Medicare tax, that was something that they passed back in 2010 with the Affordable Care Act. It actually went into effect in 2013. Now, that was one of the things that they passed to try to offset some of the costs of the Affordable Care Act, right? The good news is when you do a 1031 exchange, you can defer having to pay any of these taxes. Now, what am I not listing on the slide? Well, I'm not listing anything to do with state income taxes, right? Now, if you live in a state, or if you're selling property that is located in a state that has state income taxes, you would also be subject to state income taxes, all right? Those on the line today that are here in Florida like me, hey, we don't have state income taxes, so, we don't even need to worry about that, all right? But let's just say you own a property in California. All right, this is an actual exchange I was involved with. We did an exchange for a gentleman. He was a Florida resident. He had an investment property located in California that he was selling. Now, the good news for him, he was selling it in a 1031 exchange. But California, they have state income taxes. Now, their state income taxes can be as high as, I want to say it's like 11 or 12%. Kind of like the more you make, the more they tax you. Now, even though he was a Florida resident, but he was selling property located in California, California still wanted their state income taxes. But again, the good news for him was he was doing a 1031 exchange, so he was going to be able to get out of having to pay those state income taxes. Now, what the state of California made him do is he had to complete the state of California form. He had to submit it to the state, and that's how he got out of having to pay those state income taxes. Now, it's my understanding that he's got to submit that form every year thereafter. All right, the year he doesn't submit the form, they actually come after him for the taxes. All right, now we did another exchange for a lady. She was another Florida resident. All right, I think she was selling property located in Maryland. Now Maryland has state income taxes. All right, good news for her was she was doing a 1031 exchange. All right, now what they made her do to get out of having to pay those state of Maryland taxes, she had to complete the state of Maryland form. I think we even had to sign off on it. And I want to say she had to get it back to the state of Maryland, like, I don't know, it was like 20 or 21 days prior to her closing. So again, every state kind of has their own way of you completing some type of form or going through some type of process in order to get out of having to pay those state income taxes, right? Realtors on the line today. Y'all think about this for a minute. If that's your client, right? And they're not talking about doing a 1031 exchange, right? They're selling an investment property and they're not talking about doing a 1031 exchange. Boy, that's a perfect opportunity for you to bring it up, right? Because if they can save on the federal taxes, and also if they can also save on the state taxes, right, it's going to be even more worth their while because it's an extra savings, right? If you're the one that brings it to the table to show to them, hey, you don't have to cut that check or those checks, boy, that's going to make you look great to the client, right? And what else is that going to do? Well, if the client no longer has to cut that check or those checks, just going to give them that much more buying power, right? To go out and buy a better property. And hopefully it's going to be a higher dollar property. And also hopefully it's going to be a higher income producing property for them. And what does that do for you as a realtor? Well, hey, you look great to the client, right? But also if now they can go out and buy a higher dollar property, well, hey, hopefully you just increase your commissions. I'll be recommending a 1031 exchange, right? So good. Some things to think about for everybody on the line today, right? Now, let's talk a little bit about how do you actually calculate what the taxes are. Now, this is actually done by a CPA, but I'm just going to walk you through a real quick example just to give you an idea of how they calculate it, what potential taxes could be. All right, so in our example, originally we purchased our property for $500,000. Now, over the lifetime that we owned the property, we added back in $25,000 worth of capital improvements. Now, we also took some depreciation, okay? For the lifetime that we owned the property, we actually took $100,000 worth of depreciation, okay? And now we're going to turn around, we're going to sell the property for $1 million, all right? So in order to calculate what the taxes are, the first thing you need to do is you have to be able to calculate what they refer to as adjusted basis, all right? And basically the way you do that is you take the original purchase price of $500,000, all right? You add back in those capital improvements of $25,000, and then you deduct out the depreciation of $100,000, right? And that's going to give us an adjusted basis of $425,000. Now, how much are we selling the property for? No, we're going to sell it for $1 million, right? So we'll take that $1 million sales price, minus out the adjusted basis of $425,000, and that's actually going to give us a gain of $575,000. Now, out of that number, how much of that was depreciation? $100,000, right? So we're going to take out that depreciation of that $100,000 worth of depreciation because The depreciation recapture tax, that 25% tax, that's actually calculated at a separate line item. All right, so we'll take out the $100,000, multiply that times the depreciation recapture tax of 25%, and that would give us a tax of $25,000. Now, how much do we have left over? $475,000, right? Now, let's just say we're at the highest capital gains tax rate of 20%. So we'll take that $475,000, multiply it times the 20% capital gains tax rate, and that would give us a tax of $95,000. Now, let's also say we're going to be subject to the Medicare tax of 3.8%. 3.8%. We'll go ahead and take that 475,000, multiply it times the Medicare tax of 3.8%, and that would give us a tax of $18,050. Okay, so when we sell this property, we'd be looking at a tax rule of $138,050. Again, the good news is when you do a 1031 exchange, you can defer having to pay any of these taxes. Now, what am I not listing up on the slide? I'm not listing anything to do with state income taxes, right? So remember, if you live in a state or you're selling property that is located in a state that has state income taxes, you would also have to calculate that number, all right? Again, realtors, think about it. If that's your client, right, and they're sitting there thinking they're going to have to cut a check for $138,050, right? And then whatever's left over, hey, now let's go out and find me some replacement property, okay? Again, if you're the one that brings it to their attention, say, look, that check you're going to have to write for $138,050, do a 1031 exchange, defer all those taxes, right? Now let's go out and find you something even better. Well, that's win-win, right? The client's going to win. They're going to save on the taxes. They get to buy themselves a better property. Again, hopefully it's going to be a higher dollar property, higher income producing property for them. And you win as a realtor because why? Hey, you look great to the client, right? And now if they can buy that higher dollar property, hopefully you just increased your commissions. All right, so again, some things to think about for everybody today, everybody on the line today, right? Now, what are some of the tax advantages when you sell real property? Well, let's recap. For 1031 exchange, okay, you can only do a 1031 exchange on real property that you use in your trade or business or that you hold for investment, right? And it's a tax deferral. Not a tax avoidance. We've already talked about that. Tax deferral, meaning that, hey, if you do not continue to do 1031 exchanges, you may be subject to having to pay all those taxes. But remember that step up in basis, right? If you have heirs that inherit your property, they're going to get that step up in basis. And hey, hopefully no one ever has to pay the taxes. Now, what about your primary home? Can you do a 1031 exchange on your primary? Well, the answer is no, okay? Because on your primary, you may actually qualify for what they refer to as a Section 121, all right? And the way the 121 works to qualify for it, you had to have lived in it as your primary any 2 out of the last 5 years, all right? If you qualify, when you go to sell your primary, if you have any gain and you're single, the first $250,000 of any gain is tax exempt. And if you're married, the first $500,000 of any gain is tax exempt. Now, tax exempt meaning that you never have to pay it. It's not like a 1031 exchange where it's a deferral or, hey, you may have to pay it someday. With the 121, it's basically an exemption. You're one and done. You never have to worry about paying that. All right, now you don't need anybody like me to help you with the 121. All right, that's just something that you claim on your tax return, okay, in the year that you sell your primary residence. Okay, now here's a quick example of how the 121 can work. Let's say back in 2010, all right, we go out, we buy our primary home. Now we're going to buy it for $100,000. Now we're going to live in that property for 5+ years as our primary, okay? And then in 2016, we're going to sell it. Now we're going to sell it for $1 million. Now I know, folks, that was a really good deal. I don't know if there's any properties like that anywhere here in the Tampa area where I live, but who knows? Maybe this is property in New York or California. But for our example, we're just going to keep the numbers really simple, right? We're selling it for $1 million. We bought it for $100,000. Our gain's $900,000. Now I know that's not how you actually calculate it. You have to figure out an adjusted basis and everything else we talked about in the previous slide. But again, for our example, we'll just keep the numbers really simple. All right, so we have that $900,000 gain. Now, it qualifies for for Section 121 because, hey, we've lived in it for at least 2 out of the last 5 years as our primary. Let's say we're married when we sell the property in 2016, okay? So we're going to claim the 121. So on the first $500,000 of the $900,000 gain, well, that portion is going to be tax exempt, right? Because we're married. 500,000, we can use it to 121. That portion will be tax exempt. But what's the problem? We still have another $400,000 worth of gain that we're going to have to pay taxes on when we sell the property in 2016. Well, that's going to equate to roughly about $130,000 in taxes when we sell the property in 2016. Now, what if we could do this? What if in 2016 we could take that same property, but instead of selling it, we convert it over to an investment property? We make it a rental property, right? Let's say we rent it out for 2 years, all right? And then in 2018, we decide we're going to sell it. Now, let's keep all the numbers the same. We're still going to sell it for $1 million. We're still married when we sell it in 2018. But now that we're selling it in 2018 and it's an investment property, it now qualifies for 1031 tax-deferred exchange, okay? We can actually do a combination of a 121 and a 1031. Again, in order to qualify for the 121, had to have owned it for, had to have lived in it for any 2 out of the last 5 years, okay, which we have, right? So on that first 500,000 of gain, we're going to claim the 121, okay, and that portion is going to be tax exempt. Now, that additional $400,000 of gain, we're back in 2016 when we're selling it. In 2016, we're going to have to pay taxes on it. Now, in 2018, we're going to claim a 1031 tax-deferred exchange on that portion of the gain, and we're going to defer our taxes. So when we sell the property in 2018, we pay no tax. Okay? Here's another way you can do it. What if you want to go out, you want to buy a fourplex? Let's just say you want to live in one of the units as your primary, but the other 3 units, you're going to rent those units out. That's going to be the investment portion of it. Again, when you go to sell that property, did you live in it any 2 out of the last 5 years as your primary? If you did, you claim the 121, and on 1/4 of the gain, you claim the 121, and then 3/4 of the gain, you claim a 1031 on that portion of the gain, and you defer those taxes, and you pay no tax when you sell the property. This could work the same way if you wanted to go out and buy, let's say, a double or a duplex, right? You want to live in half, you want to rent out the other half. Again, when you go to sell it, did you live in it any 2 out of the last 5 years as your primary? If you did, to keep it simple, 50% you claim the 121 on, the other 50%, that was the investment side, you claim a 1031 exchange on that portion of the gain, and you defer your taxes and you pay no tax when you sell the property, all right? Now, I get this question pretty often. People will ask me, they say, well, Jeff, how long do I need to own a property for it to be considered an investment property? And the honest answer is, I don't know, all right? Because there's nowhere in the code that states how long you need to own a property for it to be considered an investment property, okay? The code just states that, hey, you need to use the real property in your trade or business, so you have to hold it for investment. Now, if you ask some CPAs, they'll tell you, good rule of thumb is to really hold on to the property for at least a year, for 12 months. And if you just think about the logic behind that for a minute, right? Let's say you buy your investment property this year. It's 2022, right? Well, you hold on to it for a year, for 12 months. So on your 2022 taxes, you're going to claim that property as an investment property, right? Any income that's coming in from rent, any expenses that are going out, you're going to claim that on your 2022 taxes. Now, you're holding it for a year, right, for 12 months. You also are going to claim that property as an investment property on your 2023 taxes, right? Again, any income that's coming in from rent, any expenses that are going out. So over 2 tax filing years, you will be reporting that property via tax return as an investment property. Is that a good rule of thumb? Well, the answer is maybe, all right? Now, because some other CPAs, they'll tell you, no, you really need to hold on to the property for at least 2 years or 24 months. Now, one of the reasonings behind that, we're going to talk about it in the very next slide, but back in 2008, the IRS came out with guidelines regarding vacation homes, right? And in those guidelines for vacation homes, the IRS stated for a vacation home to be considered an investment property, you must hold on to the property for at least 2 years or 24 months, right? So some CPAs pick up on that and they say, well, for vacation homes, the IRS is giving us guidelines stating for that vacation home to be considered an investment property, you must own it for at least 2 years or 24 months. Therefore, any type of investment property, good rule of thumb is to hold on to it for at least 2 years or 24 months, right? But the reality of the way the whole thing works is it's not so much about how long you own the property, it's more so about your intent, okay? And your intent could be something like this. Did you advertise the property for rent? Okay. Did you advertise it for fair market value rent? Now, if fair market value rent is, let's just say, $1,500 a month, and you're advertising it for $5,000 a month, you know what? The IRS is probably going to have an issue with that. If you get audited and the IRS comes in and says, prove to us you held that property for investment, you're going to have to be able to back it up. All right. At least one particular court case, it's referred to as Resnick versus the commissioner. Now, in that particular court case, the circumstances was you had a husband and wife, right? Now, they owned a single-family residential home. That was their primary home. Now, they also owned another single-family residential home that was an investment property, a rental property. So what they did was they sold the rental property, the investment property, in a 1031 exchange, okay? The replacement property that they purchased was another single-family residential home. That was going to be the new investment property. Now, during the 6-month period after they did their 1031 exchange, they actually ran a classified ad in the town newspaper that they lived in, advertising the property for rent at fair market value. They even showed it to 2 potential renters, but for whatever reason, they could never get the property rented out. Now, what else happened during that 6-month period was one of them loses their job, all right? So they had a mortgage on their primary home. They also had a mortgage on the investment property, but what? It wasn't rented out, right? So after 8 months of ownership, they wound up selling their primary home and they moved into the investment property. In that particular court case, it was ruled that their intent for the investment property was to hold it as an investment. But what happened? The circumstances changed, right? And they were forced to do something. So again, it's not always about how long you own the property. It's more so about your intent. And as I mentioned, if you ever get audited, you're going to have to be able to back it up. All right. Now, vacation homes. I always like to talk about vacation homes because, you know, I live in Florida. And here in Florida, you know, everybody has a vacation home or everybody wants a vacation home, all right? So how does that vacation home qualify as an investment property? Well, this is actually referred to as Revenue Procedure 2008-16, all right? And the first guideline I've already given you guys, right? You must own the property for a minimum of 2 years or 24 months. Right now, for every 12-month period of ownership, you must rent that property out for a minimum of 14 days at fair market value. All right. Now, you can actually use it for some personal use, right? For every 12-month period of ownership, you can actually use it for 14 days personal use or 10% of the total time that it was rented during that 12-month period. So let's just say during that 12-month period, you actually rented the property out for 200 days. So 10% of 200 would be what? Would be 20 days, right? So you could use that property for your personal use for 20 days instead of the 14. All right. Now, if that property meets those guidelines, it qualifies as an investment property, and you can use it in the 1031 exchange. Now, if it doesn't meet those guidelines, I wouldn't necessarily say it would be disqualified. All right. In that particular situation, I would recommend to the client, I'd say, look, talk to your CPA. And if you and your CPA can come to an agreement where you feel like you can justify that property as being an investment property, then hey, by all means, sell it in the 1031 exchange. All right. We're always going to recommend to clients, talk to your CPA. Because why? Because your CPA is going to have way more information about your tax situation than I ever would, that I even would ever want to know, right? If the CPA comes back and says, yeah, I feel like we can justify that property as being an investment property, then hey, use it in a 1031 exchange. All right. Remember in the very beginning, guys, I told y'all some of the topics that we're going to cover today. I'm going to be emailing those out to y'all. I just have them in like just single page PDFs. I have one that talks about vacation homes, right? Again, I'm going to email those out to everybody on the line today after we finish it up, okay? Now, who can actually do a 1031 exchange? So it's really important to remember with 1031 exchange, whoever the taxpayer is in the sale of the relinquished property, okay, so that's the property being sold in a 1031 exchange, whoever that taxpayer is needs to always be the same taxpayer in the purchase of any replacement property or properties, all right? So individuals can do 1031 exchanges. Husband and wives can do 1031 exchanges. Spouses can do 1031 exchanges. Sometimes we see this with spouses. Let's say one of the parties owns an investment property prior to being married. Now, let's just say it's the wife, right? So she owns an investment property, a rental property, right? Prior to being married. Now, during the course of the marriage, she decides she wants to sell that investment property, the rental property, right? Now, she wants to do a 1031 exchange because she wants to defer the taxes, right? Now, she'd like to go out and she wants to buy another replacement investment property, but in order to buy that replacement investment property, she needs to get a loan. All right, in order to qualify for the loan, she has to bring her husband in because she needs his income to help her qualify for the loan. So how can you do that with 1031 exchange? Well, one possible solution would be you might be able to take title to the replacement property as what they refer to as tenants in common. Now, hopefully everybody knows what tenants in common ownership is, but if you don't, it's pretty simple. You can own a certain percentage of a property. All right, now what may work in the situation with the husband and the wife. Now, for any of this to work, obviously you'd have to get the lender's approval. All right, but you might be able to take the wife and make her like a 99% tenant in common owner of the replacement property, and then you bring the husband in, you make him a 1% tenant in common owner of the replacement property. Again, if the lender would go for that, then you could qualify for the loan, and you could get you could buy the replacement property. Now, brings me to the next point. Tenant in common owners can actually do 1031 exchanges as well. All right, I'll give you guys an example. What if I want to go out and I want to buy an investment property, but I want to bring somebody else in with me to help me purchase it? All right, now we're going to buy the property as tenant in common owners, where I'm going to own 50% and he's going to own 50%. All right, so we buy this property 50-50, tenant in common owners. All right, now we hold on to it for a period of years, right? And then at some point we decide we want to sell it. Now, for me, I'd like to take my 50% tenant in common ownership. I'd like to do a 1031 exchange because I want to defer my taxes and I'd like to buy another replacement property. Now, my other tenant in common owner, he says, you know what? I have no desire to purchase any replacement property. I'm fine with just cashing out and paying whatever taxes are due. Well, he has the option to do that. I also have the option to do what I want to do. If I want to take my 50%, do a 1031 exchange, defer my taxes, buy a replacement property, I can do that. Now, he could do his own 1031 exchange on his 50% tenant in common ownership, defer his taxes. He could go out and buy a different replacement property. All right, so tenant in common owners can do 1031 exchange. Any type of legal entity that owns real property can do an exchange. Okay, corporations, trust, partnerships, LLCs. Okay, sometimes we see this with LLCs. Sometimes an LLC for tax purposes is referred to as a disregarded entity. Now, disregarded meaning that the actual LLC does not file a separate tax return. Anything to do with that LLC is just put on the person's personal income tax return. It's common where we see that where maybe it's just like a single member LLC, okay? And some of y'all on the line today that are realtors, you know, you might have an LLC that you set up for your real estate business, right? What do you do at the end of the year? You don't claim a separate, you don't file a separate tax return for that LLC. Anything to do with that LLC, you just put on your personal taxes. Again, that's referred to as a disregarded entity because you as an individual and your LLC are considered one and the same for tax purposes because it's all being reported under one tax return. All right, so with 1031 exchange, sometimes we see this. Sometimes somebody will own a property in their individual name, okay, an investment property. They sell it in a 1031 exchange, Now, the replacement property, they actually have the option to purchase it in their individual name, or they can actually purchase it in their disregarded LLC, their disregarded entity. Because why? Because they're all considered one and the same for tax purposes, okay? It works just the opposite way too. Sometimes we see where the LLC, the disregarded entity, owns the real property. They sell it in a 1031 exchange. You have the option to purchase it in the name of that LLC, or you could purchase it in the name of the individual, because again, it's all being filed under one tax return and they're considered one and the same. Now, sometimes we may even see this, and those are on the line that are realtors again, y'all may have seen this at some point in your career. Somebody wants to go out, let's say they want to buy 1234 Main Street. All right, so what do? Well, they go out and create 1234 Main Street LLC. That's going to be a disregarded entity, meaning what? They're not going to file a separate tax return for 1234 Main Street LLC. Anything to do with that LLC, they're just going to put in their personal taxes, right? So they buy 1234 Main Street in the name of 1234 Main Street LLC. Okay, it's an investment property. They hold on to it for a period of years, and then they sell it. And they sell it in a 1031 exchange, okay? And the replacement property that they purchase, or want to purchase, they want to purchase 5678 Central Avenue. Well, guess what? They don't want 1234 Main Street LLC buying 5678 Central Avenue. So what do they do in that case? Well, they go out and create 5678 Central Avenue LLC. That is also going to be a disregarded entity, meaning what? They're not going to file a separate tax return for that LLC. Anything to do with that LLC, they're just going to put in their personal taxes. Well, they can do that. Because why? Because all of those disregarded LLCs are considered one and the same with each other. They're also considered one and the same with the individual. Because why? Because it's all being reported under one tax return. All right. Because remember, as I said in the very beginning, whoever the taxpayer is in the sale always has to be the same taxpayer in the purchase of any replacement property or properties. Sometimes entities are set up where they're referred to as a regarded entity, meaning the actual entity itself files a separate tax return, right? If that entity sells the real property, that same entity needs to be the purchaser of any replacement property or properties. Think about it this way. If all of us on the line today, if we're all partners in a partnership, okay? Let's say the partnership owns a building, okay? Well, we don't own that building as individuals, our partnership does, right? Our partnership is going to file a separate tax return and most likely is going to issue what they refer to as K-1s to all the partners, right? If that partnership sells that building, that partnership's going to have to do the 1031 exchange. That regarded entity is going to have to do the 1031 exchange. That same entity is going to have to purchase the replacement property because, again, taxpayer in the sale needs to be the same taxpayer in the purchase of any replacement property or properties, all right? Now with partnerships, sometimes we see this with partnerships. Sometimes when a partnership sells real property, the individual partners may have different ideas of what they think the partnership should do upon the sale. You might have one partner that says, hey, I think the partnership should do a 1031 exchange to defer its taxes. I think the partnership should buy some replacement investment property. You might have another partner that says, you know what, I don't think our partnership should do anything like that. I don't think our partnership should buy any more replacement property. I don't think our partnership should do a 1031 exchange. I think the partnership should just cash out, pay whatever taxes are due. Well, how can you do that? How can you satisfy everybody's needs or wants? Well, here's two examples. Now, these are actual terms that we use in the industry, right? There's one that's referred to as a drop and swap, right? Drop and swap can work something like this. Let's say we have a multi-member partnership, all right? Let's just say we have 3 partners in the partnership. Now, the partnership owns an investment property. So the drop portion of the drop and swap can work something like this. The actual partnership will be dissolved, okay? And then the 3 former partners will become 1/3 tenant in common owners, right? They change the ownership structure to tenant in common ownership. right? So each one of the partners own the property as 1/3 tenant in common owners. Now, as tenant and common owners, they're probably going to have to hold on to the property for at least a year or two. Because why? Because they need to show that their intent is to hold on to the property for investment. And then after the year or two passes, then they can do the swap. Then they can sell the property, and then each tenant in common owner can do what they want. One wants to do a 1031 exchange, defer their taxes, buy a replacement investment property, no problem. Another one wants to just cash out, doesn't want to do a 1031 exchange, doesn't want to buy any replacement property, they can do that as well. All right, now, the opposite of a drop and swap is referred to as a swap and drop, right? That can work something like this. Again, we have that 3-member partnership, right? Owns the real property. So the swap portion of the swap and drop works like this. The actual partnership itself will sell the real property in a 1031 exchange, defers the partnership's taxes, right? But instead of buying one replacement property, the partnership will actually go out and buy 3 replacement properties. Now, why 3? Because we have 3 partners, right? And the thinking is each partner is going to have a say in what property gets purchased, all right? Now, once the partnership buys those 3 replacement properties, the partnership itself is going to have to hold on to them for at least a year or two, right? Because the partnership now has to show that its intent is to hold those properties for investment. And then after the year or two happens, then they can do the drop. Then they can dissolve the partnership, and then each former partner will get one of those properties. You know, with either one of these examples, okay, it's going to take some time, right? It's going to probably take a year or two before everything is over and done with. That's not always the case with partners. You know, sometimes when partners want to sell the property, the reason they want to sell is because they can't stand each other, right? So they have to have, to either one of these examples to work, they're going to have some type of agreement that they're willing to at least deal with each other for the next year or two. If they can't come to any type of agreement, then unfortunately, either one of these examples are not going to work. All right, so drop and swap and the swap and drop, okay? Now, I get this question probably about once a week. People will ask me, say, well, can a foreign seller do a 1031 exchange? And absolutely they can, but foreign sellers are going to be subject to an additional tax, okay? It's referred to as FIRPTA. Now, the FIRPTA tax, that's an additional 15% tax. It's based off of the gross sales price, right? Now, who are foreign sellers? Well, foreign sellers are foreign individuals, foreign entities like foreign companies, okay? Now, the good news is when you do a 1031 exchange and you're a foreign seller, you can actually get out of having to pay the FIRPTA tax. Now, the way you get out of it is you can actually apply for an exemption certificate with the IRS, okay? Now, in order to get this exemption certificate, it doesn't happen overnight, folks. It's the IRS, okay? It can take anywhere from 6 to 8 weeks to get this exemption certificate issued. You have to have a tax ID number. If you don't, you have to apply for one. You have to complete the form requesting the exemption certificate, all right? So again, it just takes some planning to get the exemption certificate issued. Other things that affect FIRPTA, if the sales price of the property is less than $300,000, and the buyer is going to live in it as their primary residence, well, there's no FIRPTA withholding, right? If the sales price is $300,000 up to $1 million, and the buyer is going to live in it as their primary residence, there's only a 10% withholding, all right, FIRPTA withholding. Now, if the sales price is $1 million or more, it doesn't matter what the buyer is going to do. If they're going to live in it or not, it's still the 15%. We don't really see that the buyers of property, 1031 exchange property, ever living in the property as their primary home. Typically, buyers of 1031 exchange property are also investors, and they never have any intent on living in the property as their primary home. But that's another way you can get out of the FIRPTA. All right, remember, guys, in the very beginning, I told y'all I have some just single-page PDFs. I have one that talks about FIRPTA and how to apply for the exemption certificate and all that type of stuff. Again, I'm going to send that out to everybody on the line today, okay? Now, related parties in 1031 exchange. So if you're going to sell to a related party when you do a 1031 exchange, or if you buy from a related party when you do a 1031 exchange, you just need to be really, really careful. Now, related parties, that's like your spouse, your kids, your grandparents. If you own 50% or more in an entity, that's considered a related party. All right. I list part of a form on the slide. That's part of IRS Form 8824. That's the actual form that you complete or your CPA completes to report your 1031 exchange on your tax return, right? Now, they don't really ask for a lot in that form, but they specifically ask, did you buy from a related party or did you sell to a related party, right? The IRS is looking for an arm's length transaction when it comes to 1031 exchange, okay? You can only buy from a related party if that party is also doing a 1031 exchange with no boot. We're going to talk about that in a minute. And each party is going to have to hold on to their respective properties for 2 years, okay? You can only sell to a related party if that party holds the property for 2 years. So again, you just need to be really careful. Anything to do with related parties, you have to dot every I, cross every T. If they're asking about that on that IRS Form 8824, it could possibly trigger some type of audit or some type of red flag. So again, please just remember that anything to do with related parties in 1031 exchange, you need to be really, really careful. Okay. Now, why is exchanging beneficial to realtors? Okay, I know we have a lot of realtors on the line today. This is a 2-hour continuing ed class for Florida realtors. So, with 1031 exchange, there's always going to be 2 transactions. There's always going to be what we refer to as the relinquished property, the property being sold in a 1031 exchange, okay? And there's always going to be a replacement property, the property that's being purchased in a 1031 exchange. So 2 transactions. Well, what does that mean for you guys as realtors? 2 commissions, right? Now, one of the rules to exchanging, the replacement property that gets purchased in a 1031 exchange, okay, that purchase price must either be equal to or greater than whatever the sales price was in the property that was sold, the relinquished property. So what does that mean for you guys as realtors? What that means is the replacement property that you purchase in a 1031 exchange, okay, that commission that you make on that property is going to be as good, if not better, than what it was on the property that was sold, the relinquished property, just because of that rule. Now, the 1031 tax savings benefit, yeah, we've kind of already talked about that. Think back to the slide when we calculated what the taxes were, right? That client sitting there thinking they're going to have to cut a check for $138,050. Again, if you're the one that brings it to their attention, all right, if they can avoid having to pay those taxes by doing a 1031 exchange, just going to give them that much more buying power to go out and buy a better property. Hopefully, it's going to be a higher dollar property. And what is that going to do for you as a realtor? Hopefully, you can just increase your commissions, all by recommending a 1031 exchange, right? Now, I'll tell you what, sometimes we even see this. Sometimes the property that's being purchased in a 1031 exchange, okay, that seller of that property, they may also be an investor, okay? But guess what? They don't know anything about 1031 exchange. Now, hey, maybe you have the opportunity to talk to them about doing a 1031 exchange, okay? Who knows? Maybe you can help them find some replacement property, pick up another transaction, all right? Now think about this for a minute. Any property out there that is non-owner occupied is a potential 1031 exchange candidate. Now, why? Because if they don't live in the property, they might be holding that property as an investment. Okay, now there's databases that you guys can tap into to get those kind of leads. Okay, there's one that I know of. It's actually referred to as List Source. Okay, now List Source, it's a product of CoreLogic. Now you'll probably have heard of CoreLogic. CoreLogic is a huge database company. All right, so they have a product called List Source. Now within List Source, you can do searches by zip code, geographical area, subdivision, and so on. And the results it'll actually give you the mailing address of the property, and it'll give you the property address. Okay, if those 2 addresses are different, you know they don't live in the property. All right, you could target the mailing address to the actual owner of the property, because I tell you, we see this all the time. Somebody will own an investment property, a rental property, right? And they've owned that thing for years, and they know if they ever sell that property, they're going to be looking at a huge gain, right? And they're going to have to cut a check to the government. And you know what? They just don't want to cut that check, right? So what do? They just hold on to the property, not knowing they have any other options out there. Again, if you target that mailing address, you target the owner of the property, and you say, hey, you do have an option. You can do a 1031 exchange, defer your taxes, avoid having to cut that check. Now let's go out and find you something even better. Hey, who knows? Maybe they can sell that one investment property in a 1031 exchange. They might even be able to buy themselves two replacement properties, where no longer are they just having that one income stream coming in from that one property. They wind up buying two properties with two tenants, two separate income streams. Well, hey, they're not so reliant on just having that one tenant anymore, because if they lose one of the tenants, they still have some income coming in every month. Right now, you could even target the property address. Why? Because, hey, they may have a tenant in the property that's looking to buy something. I don't know. Maybe they're looking to buy that property they've lived in for all those years, but what? The owner was never willing to sell it to them. All right. Now, here in Florida, within the MLS system, realtors tell me there's a product that's referred to as iMaps. There's also another product that's referred to as Remind. Maybe in some of the other MLS systems throughout the country, if you're not a Florida realtor, you have access to those same types of products, okay? Also, depending on the county, some of the county or property appraisers offices will let you do searches by absentee owners. Now, people tell me with iMaps and Remind, you can do searches by absentee owners. Absentee owners, they don't live in the properties. They might be holding them as investments, all right? If anybody on the line today works any type of like beach community, all right, up and down the East Coast or the Gulf Coast, all right, here in Florida, in Central Florida, we have all the theme parks, Disney, Universal, SeaWorld, okay? There's absentee owners in all of those areas, all throughout the country, right? They might be holding those properties as investment, right? Again, you have the tools out there. You just need to tap into them. You know, if you've always thought, hey, I'd love to be able to get my foot in the door with investors, but how do I do that? Well, maybe 1031 exchange becomes a tool for you to go out there and target those investors. And you have the tool, you have the databases at your disposal, right? You just need to tap into them or learn how to use them, all right? So again, some things to think about for everybody on the line today, right? Now, the guidelines for 1031 exchange, we're going to talk about property qualifications. There's some tax deferral requirements. There's some timelines everyone needs to be aware of. And there's also some identification rules, all right? So let's recap. What type of property can you do a 1031 exchange on? Any type of real property that you use in your trade or business or that you hold for investment, you can exchange it for what? Any type of light kind property, which is what? Any type of real property that you use in your trade or business or that you hold for investment. And where can those properties be located? Anywhere in the country, right? Anywhere in the United States, including Guam, U.S. Virgin Islands, or the Mariana Islands. Remember, property in Puerto Rico is not included in that number, all right? Now, what types of property are excluded from 1031 exchange? Well, your primary residence. We've already talked about that, right? What do you do for your primary? Well, may qualify for that section 121, right? Now, property held for sale is also excluded from 1031 exchange. Now, I'll give you all a quick example of maybe the way that could work. You know, here in Florida, we have a lot of these national home builders like Pulte Homes, Lennar Homes, KB Homes. Let's just say I'm Pulte Homes. Now, Pulte, they're one of the largest single-family residential home builders in the entire country, right? They're a publicly traded company. They build newly constructed properties in multiple states, right? Multiple states throughout the United States. Now, the properties that they build, when those properties are completed, what do they do with them? Well, they turn around and sell them, right? Because they're holding those properties for sale and not for investment, they can't do 1031 exchanges on those types of properties, all right? So property held for sale is excluded from 1031 exchange. Now, dealer property is also excluded from 1031 exchange. I'll give you guys an example of maybe what's considered dealer property. Let's say I'm a flipper, right? Let's say I buy a property, I don't know, 2 or 3 months goes by, and during that 2 or 3 months period, I fix the property up. And then when it's completed, what do I do with it? Well, I turn around and sell it. Well, I can't do 1031 exchanges on those types of properties because why? Because that's like that's like my business. That's my inventory. I'm in the business of buying properties, fixing them up, and then what do I do with them? I turn around and sell them. Well, you can't do 1031 exchanges on those types of properties. Now, here's a potential solution for a flipper. Let's say they buy a property. Again, 2 or 3 months goes by, they fix it up, and then when the property is completed, instead of listing it for sale, they go to their realtor and they say, "Hey, can you put this in the MLS system showing it for rent? Now let's make sure we put it in there for fair market value rent as well." That's a little bit different, right? Because why? Because now all of a sudden, what are they doing? They're showing their intent that they're holding it for investment and not for sale. Hey, who knows? maybe they even show it to a potential renter. I don't know. They run some type of credit check on that potential renter. They don't have such great credit, and they decide not even to rent it to that potential renter. Okay, if that flipper ever gets audited, and the IRS comes in and says, "Okay, prove that you held that property for investment and not for sale," they're going to have to be able to back it up. All right, and the example I just gave you guys, yeah, there's a good chance they could, right? They could say, "Look, here's an email that I sent to my realtor on such and such a day, requesting that they put it in the MLS system for fair market value rent," right? Here's the MLS listing showing it for fair market value rent. Here's the potential renter that I showed the property to. Here's the credit check I ran on that potential renter. All of that type of stuff is going to be what? It's going to be their backup, right? It's going to be their proof to show that their intent was to hold the property for investment and not for sale. But remember, if they buy the property, and however long it takes for them to fix it up, if when it's completed, they turn around and try to sell it, you can't do a 1031 exchange on that type of property. All right. Now, foreign property is also excluded from 1031 exchange. Now, this might be pretty obvious to everybody on the line, but let's say I couldn't sell an investment property located here in Florida in a 1031 exchange and then try to buy a replacement property, I don't know, somewhere in Canada or Mexico or Europe. Has to be what? Has to be property located in the United States, including Guam, U.S. Virgin Islands, or the Mariana Islands, right? So foreign property is excluded from 1031 exchange. Now, what are the tax deferral requirements? So in order to defer your taxes 100%, okay, rule number one is you must reinvest all of the net proceeds in property of equal or greater value. So what exactly are the net proceeds? What does that mean? The net proceeds, that's the cash, all right? That's the cash that normally you would get out of the closing. Now, we're the qualified intermediary, the QI. We're going to hold those proceeds on behalf of the seller, the exchanger, because why? Because they can never have receipt of those funds. If they do, they would lose their ability to do a 1031 exchange, okay? So they can't close today. Call me tomorrow and say, "Hey, Jeff, I want to do a 1031 exchange," okay? At that point, it's too late, right? They couldn't even close today. Leave the title company, attorney's office, escrow company, where they just did the closing. Get in the parking lot. Call me from their car in the parking lot and say, "Hey, Jeff, I want to do a 1031 exchange." At that point, it's too late because that company that just did the closing, their funds may be sitting in their escrow account. They may be waiting to wire their funds out to the client. At that point, they have what's referred to as constructive receipt. They have a legal right to the funds. They've lost their ability to do a 1031 exchange, okay? So we have to get involved prior to the closing, basically prior to them walking out the door. Now, we're going to hold the proceeds on their behalf, okay? What's the rule? Well, they have to take that entire amount, okay, and they have to go out and they have to buy a replacement property, or it can even be multiple properties if they want, where the purchase price or the combined purchase prices, if it is multiple properties, is either equal to or greater than whatever the sales price was on the property that they sold. Okay, that's rule number one. Now, rule number two is if they have debt, okay, you're required to obtain an equal amount or greater debt in the purchase of any replacement property or properties. Now, that rule can actually have an exception. If you have cash that you can add to the purchase of your replacement property, you can offset that rule. Now, what exactly does the debt mean? What that means is if you have a mortgage, all right, if you're paying off a mortgage, whatever the payoff amount is, you're required to obtain a mortgage of at least that amount or greater in the purchase of any replacement property or properties. Now, if you don't want to do that, the exception is if you have cash that you can add to the purchase of your replacement property, you can offset the debt amount, right? Or if you have some cash and you make up the difference in a loan, that would work for you as well. All right, let me show you all an example of the way the numbers work. All right, so in our example, we're going to sell our relinquished property for $1 million. All right, now we have some debt, we have a loan that we're paying off, okay, and the payoff amount, the mortgage amount, payoff mortgage amount is $300,000. So we'll take that $1 million sales price, we'll deduct out the $300,000 mortgage payoff. Now we have some costs associated with the sale. That's going to be $50,000, let's just say. That's going to be like real estate commissions, title insurance, closing fees, some of those non-reoccurring type fees, okay? Let's say that's $50,000. We'll deduct that out, and that's going to give us net proceeds of $650,000. Now again, we're the qualified intermediary, the QI. We're going to hold that $650,000 on behalf of the seller, the exchanger, right? Because again, they can never have receipt of those funds. If they ever do, they would lose their ability to do a 1031 exchange, right? So we're going to hold that $650,000, and then what are they going to do with it? Well, in this example, they're going to take that entire amount and they're going to use that towards buying a replacement property of greater value. They're going to buy a property for $1.2 million. All right. So by doing that, they just meet rule number one. Because why? Because they've used all the proceeds, and they're actually going to be buying a property of greater value than what they sold. Right? They sold for $1 million. They're buying a property for $1.2 million. Now, they still need an additional $550,000 to help them do that. So what are they going to do? Well, in this example, they actually go out and they get a loan for $550,000. By doing that, they just meet rule number two. Because why? Because they had a loan that they paid off. The payoff amount was $300,000. They actually acquired a loan of greater value, right? The new loan is $550,000. Now, if they do this, they'd get a full deferral. They would defer their taxes 100%. Now, you remember I told y'all with rule number two, there can be an exception. Here's how it could work. Let's say they didn't want to get a loan for $550,000. Okay, what are their options? Well, if they would have had $550,000 cash that they could add to the purchase of the replacement property, that would have worked for them. Or they may say this, they may say, well, we don't have $550,000 in cash. We do have some cash that we're willing to put towards buying the replacement property. And then the difference, we'll make that up in a loan. Any of those scenarios would work for them. Okay, now what if they wanted to do this? What if out of the $650,000, they say, well, we don't want to use all of that towards buying replacement property. We want to hold, let's say they want to hold $100,000 back, and they only want to use $550,000 towards buying the replacement property. Well, they can do that with 1031 exchange, but that $100,000 that they hold back, that they put in their pocket, they're going to be subject to taxes on that amount. All right, that's referred to as cash boot. It doesn't mean that they can't do a 1031 exchange. It just means that instead of them getting a full deferral, they're going to get what's referred to as a partial deferral. Now, partial, why? Because they're going to be subject to taxes on that boot, that $100,000. Now, that $100,000, they can do whatever they want with it, all right? They want to pay off bills, they can do that. They have a child starting college, they want to pay for college, they want to go on a great vacation. Hey, I don't know, they want to go to Vegas, they want to blow it all gambling. Whatever they want to do with that $100,000, they can do with it. But again, they're going to be subject to taxes on that amount, all right? Now, back to the example. We're going to hold $550,000, right, out of the $650,000. And what are they going to do with it? Well, they're going to use that entire amount towards buying a property of less value. They're going to buy a property for $800,000. Now, they still need another $250,000 to help them buy that replacement property for $800,000. So what do they do in that case? Well, in that case, they go out and get a loan for $250,000. But by only getting a loan of $250,000, they actually go down in debt by $50,000, right? Because the loan that they paid off was $300,000, and they actually acquired less debt by getting a loan of $250,000. So that $50,000 of less debt, they are also going to be subject to taxes on that amount, all right? That's referred to as mortgage boot, all right? So there's two different types of boot. There's mortgage boot and there's cash boot. Again, doesn't mean you can't do a 1031 exchange. It just means that you're going to get a partial deferral instead of a full deferral. Now, if anybody ever wants to do anything like this, I always tell them, I say, look, you really need to talk to your CPA, because you have to look at it and say, okay, if I don't do a 1031 exchange, what's my tax situation look like? Now, if I do a 1031 exchange, but I pay some taxes on the boot, what's my taxes look like? All right. Again, usually the taxes that you pay on the boot are going to be significantly less than if you just sell the property outright. But if your CPA comes back and says the taxes that you're going to pay on boot are going to be more than if you just sell the property outright, then it's an easy decision, right? Don't do a 1031 exchange. It's not going to be worth your while. You're going to lose money. So again, always talk to your CPA. Make sure you know your numbers, okay? Now, there's some timelines everyone needs to be aware of with 1031 exchange. So from when you sell your relinquished property, from that date forward, from the closing date forward, you're going to have 180 calendar days to purchase any replacement property or properties. And that's calendar days, all right? It's holidays, it's weekends. Hey, I live in Florida, okay? From June 1st to November 30th is what? It's hurricane season, okay? If we're getting hit with a hurricane and everything shuts down for a day or two or a week, whatever it may be, none of that matters with 1031 exchange. The clock is always going to be ticking. All right, so you have 180 calendar days to purchase your replacement property or properties. Now, the first 45 days of the 180, they refer to that as the identification period. So what exactly does that mean, right? Well, the identification period means this. You must identify any potential property or properties that you want to buy. Now, they don't have to be under contract. You just have to identify any potential property that you want to buy by midnight of the 45th day. All right, that's something else that we're going to help assist with, right? We're going to provide to the client what we refer to as the identification ID letter. All right, and on that form, there's going to be some blank lines, and it's going to have to be specific to a property address or addresses. Client's going to have to fill it out, sign off on it, get it back to us by midnight of the 45th day. Okay, that's how they will formally identify their replacement property. They're going to do it to us, the qualified intermediary. Okay, but here's the thing about the 45 days. Let's just say they find the perfect property, but it's day 46. At that point, it's going to be too late for them. All right, so whatever they put on that form, by midnight of the 45th day, they're going to have to make sure they're going to be able to purchase at least one of those properties. And when do they have to purchase it by? They have to purchase it by day 180, right? If they're buying that property and it's day 181, unfortunately, they're going to be paying all of their taxes, right? There is no exceptions to these timelines. You have to identify within the first 45 days, and you have a total of 180 calendar days to purchase your replacement property or properties. All right. Now, there's actually some rules to identifying. All right. There's 3 different identification rules. Okay. I'm going to read each one of them to you, and if you don't quite understand them when I read them to you, don't worry about it. All right. I'm going to show you all examples of how the numbers work for each one of these rules. And hopefully, once I show you how the numbers work, it's going to make sense to you. All right. Now, the most popular rule that we see investors enacting is the first rule. All right. It's referred to as the 3 property rule. Now, the 3 property rule states that you can identify up to 3 properties without regard to the fair market value of those 3 properties. So what exactly does that mean? Fair market value? That's the purchase price. Okay. So if you identify 3 properties or less, the purchase prices of any of those properties can be any dollar amount. It does not matter as long as you identify 3 properties or less. Now, if you want to identify more than 3 properties, you can do that, but it's going to put you into this next rule. All right, it's referred to is the 200% rule. All right, and the 200% rule states this. You can identify over 3 properties, but you could not exceed 200% or 2 times the combined fair market value of the property being sold. So what exactly does that mean? Well, what that means is if you identify more than 3 properties, the combined purchase prices of all those properties that you identified cannot exceed 200% or 2 times whatever the sales price was on the property that you sold, right? Now, if you want to exceed the 3 property rule, you also want to exceed the 200% rule, you can do that as well. But it's going to put you into this next rule, all right? It's referred to as the 95% rule. Now, the 95% rule states that you can identify over 3 properties, you can exceed the 200% rule, but you must acquire at least 95% of the value of all the properties being identified. All right, now I know that's probably about as clear as mud. All right, it doesn't make a lot of sense, but just remember, everybody, this is the IRS, and sometimes this stuff does not make sense, right? This 95% rule, it's really rare that we even see investors enacting this rule, okay? As I mentioned, it doesn't make a lot of sense, but hey, sometimes this stuff just doesn't make sense, right? Let me show y'all the examples, especially with the 95% rule, and hopefully once I show you the examples, it'll clear it up for you, all right? So here's the 3 property rule. Again, if you identify 3 properties or less, okay, the purchase prices can be any dollar amount, all right? It does not matter as long as you identify 3 properties or less. All right, so here's a quick example. We sell for $1 million. All right, now we go out and we identify 3 properties. Because we've identified 3 properties, we're in the 3 property rule, right? Let's just keep the math simple. Let's say we're going to be buying each one of those properties for $1 million each. So how much have we identified in property? $3 million worth of property, right? Again, it doesn't matter. As long as it's 3 properties or less, the purchase prices can be any dollar amount. It doesn't matter. We could be buying each one of these properties for, I don't know, $10 million each for a total of $30 million in identification. It doesn't matter as long as it's 3 properties or less. But what does matter? I'll say it again, folks. If you identify 3 properties, boy, you better make sure you're going to be able to purchase at least one of those properties. So, you know, you're not required to have any of the properties under contract as far as identification goes, but in practice, what we typically see investors doing is they will put one property under contract. You know, especially the market that we have right now, you know, it's a seller's market. Properties aren't staying on the market that long. You know, the best way to lock up a property is to do what? Is to put one of them under contract. So that's typically what we see is an investor will put one property under contract. That's one of the properties that they identify. And then, I don't know, maybe they'll identify 2 other properties just as backup. Because again, if after midnight of the 45th day, if that property that they have under contract, if that whole deal falls apart, at least they would have the opportunity that to purchase those other 2 properties that they would have identified, right? So that's the 3 property rule. Now, here's the 200% rule. This is where you exceed the 3 property rule, but then you cannot exceed 200% or 2 times the combined fair market value of the property being sold. So here's how it works. Again, we sell for $1 million. Now, in this example, we actually go out and we identify 5 properties, okay? Because we've identified 5 properties, what just happened? We exceeded our 3 property rule, right? So that puts us into the 200% rule. So what exactly does that mean? What that means is the combined purchase prices of all 5 of those properties cannot exceed $2 million. Now, you may be asking yourself, where is he getting the $2 million from? Well, we sold for $1 million, right? So 200% of that $1 million sales price, or 2 times the $1 million sales price, is how much? $2 million, right? So that's where I'm getting the $2 million from. I think this one is pretty straightforward. Hopefully everybody gets it, okay? Now, here's the 95% rule. Again, this is where you exceed the 3 property rule. You exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you identified. Here's how it works. Again, we sell for $1 million. Now, in this example, we actually go out and we identify 10 properties, all right? Because we've identified 10, what just happened there? We exceeded our 3 property rule, right? Let's keep the math simple on this one as well. Let's say we're going to be buying each one of those properties for $1 million each. So how much have we identified in property? $10 million worth of property, right? Because we've identified $10 million worth of property, we've actually have exceeded our 200% rule, because that was how much? $2 million, right? So that's going to put us into this 95% rule. So in our example, let's just say we're only able to purchase 9 out of the 10 properties that we identified. That's only 90% or $9 million, right? That is not 95%. If we only purchase 9 out of the 10 properties, we're actually going to blow our entire exchange, and we're going to have to pay all of the taxes. All right. So the reality of the way the 95% rule works is it's really 100% of whatever you identify, you're going to have to buy. And we're using really simple numbers, right? We're saying, hey, all the purchase prices, they're going to be an even $1 million. You know, those purchase prices, they're going to be all over the map, right? It's going to be really hard to sit down and say, let's see, hey, maybe if I get this one property, oh, that's only going to put me at 93%. All right, maybe I need to make sure I purchase this other property. Oh, wait, it's only going to put me at 94%. Again, the 95% rule, in practice, the way it works is really 100% of whatever you identified. All right, the IRS wants to limit you in how many properties you can identify. They don't want you going out there and identifying everything under the sun, right? Because you know what's going to happen if you identify everything under the sun? You're going to have to buy everything under the sun because of this crazy 95% rule. Again, it's very rare that we even see this rule enacted, but just realize it does exist. It's out there. And if you individually, or you have a client that ever gets into it, they're going to have to buy whatever they've identified. Okay. Now, how does the whole closing process work with 1031 exchange? Well, you know, we really don't get involved or get the process started until there's a contract on the property that's being sold, on that relinquished property, because I need to get a copy of the contract. I will also need to get the contact information for whoever's handling the closing, along with the client's contact information, because what happens is we reach out to that escrow company, title company, attorney's office, whoever's doing the closing, and what we get from them is a copy of the title commitment. It's also referred to as a title search, the title binder. It just depends on the different areas of the country where you live, but it's the title search, okay? Once we have that in hand, along with the contract, then what happens on our end is we prepare what we refer to as an exchange agreement, and those are going to be documents that will set up the exchange, okay? We're going to email those over to whoever's going to be handling the closing. Those documents will be sitting there waiting for the closing to happen, all right? Day of closing, seller's going to come in, they're going to sign those documents. That's going to set their exchange up. But by signing those documents, that's going to give us the ability to step into their shoes as the seller, right? That's also going to give whoever's handling the closing the ability to take the proceeds from that sale, and they're going to wire us those proceeds, and we're going to hold them on behalf of the seller, the exchanger, our client, okay? That transaction takes place. And then from that date forward, what happens? The clock starts ticking, right? 180 days to close. The first 45 days of the 180 is the identification period, right? We're going to be sending out that identification ID letter. Client's going to fill it out, sign off on it, get it back to us by midnight of the 45th day. Now, once they get a contract on whatever replacement property they want to buy, all right, we'll need to get a copy of that as well. We also are going to need to get the contact information for whoever's going to be handling that transaction, because chances are it's going to be a different company that handled it who handled the sale, all right? Because you think about it, we need a contact person. We're going to need to get that company's wiring instructions, okay? We're going to prepare some other documents that we're going to send over to that company, all right? Day of closing, the buyer's going to come in, they're going to sign those documents. That's going to give us the ability to step into their shoes as the buyer, right? That's also going to give us the ability to take the proceeds that we've been holding from their sale, and we're going to wire those proceeds over to whoever's going to be handling that closing to help them purchase their replacement property, right? That's it. That's the entire closing process. You know, it's not really that complicated of a process when it comes to the closing. Just everything leading up to it is the complicated stuff. Everything that you see day in and day out in the whole real estate world, negotiating contracts, identifying your replacement property by midnight of the 45th day, deciding if you need to get a loan or you need to add cash, applying for the loan, all that type of stuff is the more complicated stuff, okay? But when it comes to the closing process, that's probably the easier part. of 1031 exchange. All right. Now, everything that we talked about today, all right, the most common type of exchange that we do, probably 90 to 95% of all the exchanges that we do are referred to as a delayed exchange. And again, that's exactly what we talked about today. It's actually when you sell first, you sell your relinquished property first, and you buy your replacement property last. You're buying that replacement property by what? Day 180, right? Again, that's a delayed exchange. Again, most common type of exchange, but there's a few other type of exchanges, right? There's one that's referred to as a reverse exchange. Now, the reverse exchange works just the opposite of a delayed, right? It's actually where you buy first, you buy your replacement property first, and then you sell your relinquished property last. Now, with 1031 exchange, you can't exchange it to something you already own, right? So what happens with the reverse exchange, they can work something like this. Let's say you have your property listed for sale, okay? Client, they go out, they find the perfect replacement property, okay? All right, and they know if they don't act fast, they're going to lose out on being able to purchase that perfect replacement property because, hey, it's a market like we have now. It's a seller's market, right? Properties are turning over really quickly, and, you know, by the time they sell their relinquished property, that perfect replacement property, you know what, that may already be sold because it's that kind of market. So what can they do? Well, they can do this thing called the reverse exchange. And what happens in the reverse exchange is we actually come in, we form a separate company, all right? It's referred to as an exchange accommodating title holder, EAT for short. We come in and we buy the replacement property. We go on title, okay? Now, when we buy the replacement property, okay, you must be able to sell your relinquished property within 180 days, all right? So there's the 180 coming back into play. Guys, it never leaves. It's always going to be involved or show up in some form or fashion with 1031 exchange, okay? What are some of the positives for a reverse exchange? Well, as I mentioned, hey, you got a seller's market, properties are turning over really quickly, client finds that perfect replacement property, they know they have to act quickly or it's going to be sold, they may lose out on to be able to purchase it, you can do the reverse exchange. Now, sometimes we even see this, and some realtors on the line, you may have had clients like this. You might have a client like this right now. You know, they list their property with you, right? And they think, boy, my property is the greatest property in the world. I'm not going to have any problem selling it. So what do? They go out and put a contract on a replacement property. And then what happens? Reality sets in, right? The client realizes, hey, maybe I don't have the world's greatest property because I'm not getting all those showings like I thought I was going to get. I'm not getting all those offers like I thought I was going to get. But guess what? They already have a contract on that replacement property, and that closing date is fast approaching. What can they do to save the whole deal? They can do the reverse exchange. Now, what's the biggest obstacle, the biggest negative to overcome in a reverse exchange? Well, the financial part. Okay, now we're a great company, but we're not just going to come out of pocket and buy the replacement property, all right? The client's going to have to be able to give us the financing to be able to do that. Typically, it's going to have to be cash. Now, why do I say cash? Because if the client is trying to get a loan through a traditional lender, a conventional lender, conventional lenders are not going to loan funds at that point, all right? Because we're not the borrower, the client is, okay? We're actually going on title, the client is not. So typically, they're going to have to come up with cash. Now, hey, maybe they have some type of great banking relationship. You know, they can get some type of line of credit. Some people tell me, hey, some of these hard money type lenders, they'll do deals like that all day long. You know, for us, it doesn't really matter. Just some way, somehow, the client's going to have to give us the financing in order to be able to purchase that replacement property. All right, now what's the other negative? Well, you have to be able to sell your relinquished property within 180 days from when we purchase the replacement property. What happens if you don't? If you don't sell your property within 180 days? Well, come day 181, you're going to own an additional property. All right, we're not going to hold on to it. The client's going to own an additional property. Now, they're not going to have any type of capital gains tax or anything because why? Because they never sold anything, right? Now, they may ultimately say, well, I still want to sell my investment property. No problem. They can still do that, okay? They can do a 1031 exchange, but they're going to have to designate a new replacement property because the original replacement property, they would have already owned it, All right, so again, that's called a reverse exchange. Now, there's another type of exchange. It's referred to as a construction exchange. Another term you may hear people refer to it is an improvement exchange or a built to suit exchange. Now, they can work something like this. All right, you sell your property in a 1031 exchange. Okay, now we're the qualified intermediary, right? We're going to be holding the proceeds from the sale. Now the client goes out, they find a replacement property, but it's not everything they want. Okay, they want to do some improvements to it before they actually acquire it. Well, what can you do in that case? Well, you can do this thing called a construction improvement or built to suit exchange. We can take the proceeds that we're holding from their sale, we come in, we form that company again, the EAT, the Exchange Accommodating Title Holder. We can take the proceeds and then we buy the replacement property. And then we oversee any improvements. Okay, we're working with the contractors, we're handling disbursements to those contractors. Now, we're getting input from the exchanger, the client, the entire time. Okay, now those improvements need to be done within 180 days. All right, so again, there's the 180 coming back into play. As I mentioned, it's never going to leave with 1031 exchange. It's always going to be there in some form or fashion. Now, the next type of exchange, now I call it a non-appreciation exchange, right? Because sometimes, especially if you're a realtor, you might have a client that tells you, hey, I bought my property in the height of the market. Let's say they tell you, I bought my property in the height of the market. I bought it for $1 million. Now I've owned that property for years, and now I'm going to sell it. And basically, I'm selling it for what I bought it for. I'm selling it for $1 million. So on the surface, the client may it may appear that there is no gain, right? Because hey, they bought it, they're selling it for what they bought it for. But you'll remember depreciation recapture tax, that 25% tax. Let's just say that same client took $200,000 worth of depreciation for the lifetime that they own that property. When they go to sell that property, they're going to be hit with that 25% depreciation recapture tax on that $200,000. That's going to equate to $50,000 in taxes that they're going to have to pay when they sell that property. They can still do a 1031 exchange and defer the depreciation recapture tax. So again, if you ever have a client that is sitting here telling you, hey, I have no gain, I'm selling it for what I bought it for, just simply ask them, say, look, have you talked to your CPA? Do you know your numbers? Because again, you don't want them to be in for a shock when they sell their property, not realizing that, hey, they could have done a 1031 exchange and deferred that depreciation recapture tax. All right. Some other red flags. If you ever have a client that tells you the investment property that they're selling, they actually acquired that in a 1031 exchange, but they're not talking about doing a 1031. That's got to be a red flag for you as a realtor as well. Because why? Because remember, 1031 exchange is a tax deferral. It's not a tax avoidance. If they don't do another 1031 exchange on the sale of that current investment property, they're going to be subject to whatever taxes are due on that transaction. Any of those previous 1031 exchanges where they deferred their taxes, they also could be subject to having to pay those taxes as well. All right. All right, last slide. What do we actually charge for our services? Well, for the delayed exchange, again, that's the most common type of exchange, all right? That's where you sell first, you sell your relinquished property first, and then you buy your replacement property last. You're buying your replacement property by day 180. We charge a flat $12.50, all right? We don't collect anything until the closing happens, right? Just like realtors, you don't earn your commission until a closing happens, neither do we. I just walked y'all through the entire closing process. We like to start doing our thing. Once the contract gets signed and the property being sold, we prepare the exchange agreement. We send that over to the title company, escrow company, attorney's office. Those documents are sitting there waiting for the closing to happen. If it never gets to closing, if the whole contract falls apart, the buyer walks, the client, the seller decides, hey, at the last minute, they don't want to do a 1031 exchange. No problem, all right? We don't charge any type of cancellation fees. We don't charge any type of setup fees. We don't charge any type of wiring fees. Our $12.50, again, it's not incurred into the day of closing. And what does the $12.50 cover? It covers the sale of one property, and it actually covers the purchase of up to 3 replacement properties, okay? So there's no additional charges, there's no additional fees. It's a flat $12.50. Now, for the reverse exchange, okay, that's what you buy first. You buy your replacement property first. You sell your relinquished property last. Now, those can be significantly more complicated than a delayed exchange. You know, we have to form a separate company. We're going on title. Those start off at about $6,500. I mean, $8,500. Sorry. Okay. The construction and improvement exchange, the built-to-suit exchanges. All right. Those can be significantly more complicated than a delayed exchange. You know, we're forming a separate company. We're going on title. We're working with contractors. Okay, those start off at $8,500 as well. Remember in the very beginning, I told y'all one of the owners of our company is a tax attorney, Adam Skarsgård. Adam personally handles any reverse exchanges, construction, built-to-suit, improvement exchanges that we do. You know, he looks at each one of them individually. Okay, gets all the facts, figures out how complex they're going to be, and bases our fee off of the complexity. Okay. All right. Well, we're doing good. We're just about out of time. I'll go ahead and open the floor up to questions. If you have any questions, there's a box on the right-hand side that says questions right there. Please just go ahead and feel free to type your questions in. While we're waiting for the questions to come in, I'll remind everybody, today's presentation was recorded. Okay, you're going to receive a link to today's presentation if you want to refer back to any of the topics that we discussed. And, you know, as I mentioned here and there, some of the topics that we covered today, I have in PDF form. Okay, I'm going to email those out to everybody on the line today. Now, some of the literature that I have, I actually have in Spanish and also in Chinese. If you want those additional languages, please let me know. Okay. Also, today's class was worth 2 hours of continuing education for Florida realtors. If you did not give me your correct MLS number, I mean, sorry, not MLS, your correct Florida real estate license number that includes the SL or the BK, please email that to me. Okay. Because as I mentioned in the very beginning, I have to take your first and last name along with your license number, including the SL or BK. I have to manually upload that information to the state of Florida in order for you to get your 2 hours of continuing ed. All right. Today's class was a 2 hours class. Obviously, I have two other classes that I teach. One's a basics class. It's about an hour. I also have an advanced class that's about an hour and 15 minutes. Okay. I do a lot of my classes for individual real estate offices, boards of realtors, title companies, attorneys' offices. If you have other colleagues of yours that you think would benefit from me doing one of a class for your individual office, please let me know. Okay, I have information I can send you on all of the classes. If you have to send that on to the powers that be, your manager, broker, owner, whoever it may be, please let me know. I'd be glad to do that for you. And you know, don't feel like you have to be a 1031 exchange expert. Okay. I talk to people about 1031 exchange all day long. All right. I want to be a resource for everybody on the line today. Okay. If you have clients that have 1031 exchange needs, please let me know. Individually, if you're an investor, please let me know. I'd be glad to talk to you. The email that I send out with the attachments, so what some people do is they'll forward that on to their client, include me on the email, pick and choose what PDFs apply to their client, introducing me to their client, and then I can follow up with them. You know, if that works for you, it works for me. All right. So let's get to the questions. Let's see what we have coming in here. All righty. All right. Let's see. We have a question. Could you will send the PPT copy to our email? I'm not going to send out the PowerPoint. It's a pretty large file. Like I mentioned, you're going to receive a link to today's recording. If you want to listen to it, I think it gives you the ability to download it if you'd like. The PDFs I'll send those out, as I mentioned, various topics. One is more of just a general one if you wanted to forward that on to someone. Okay. All right. Somebody wasn't able to get audio. Amanda, I'm sorry. Hopefully you figured it out eventually. Didn't have any other issues. Nobody else mentioned they weren't receiving any audio. Let's see. This is from Claudia. On top, it's also a great thing for a seller because with his buyer who does a 1031 exchange, it's like a cash buyer. I'm not exactly sure what that means, but you exit at 11:30, so it was kind of a little more than halfway through. I'm not exactly sure what you're referring to there, Claudia. Sorry. Another question from Claudia: can an S corp selling a property do a 1031 exchange with the property of a C corp, where the same person is behind? Just remember, again, whoever the taxpayer is in the sale needs to be the same taxpayer in the purchase of any replacement property or properties. S corps, C corps, whatever it may be. Again, whoever that taxpayer is has to be the same taxpayer in the purchase of any replacement property or properties. Hopefully that answers your question. If not, give me a call or shoot me an email. We can definitely talk in more detail. I know sometimes it's hard to type in a detailed question in like 30 seconds. I totally get that. If you want to talk on the phone or you want to type an email with more details, let me know. All right. It looks like you actually exit at 11:51. So we weren't, maybe I hadn't covered the rules yet about a same taxpayer possibly at the time. Let's see, what if you buy land with intent to build multifamily on it with a 1031 exchange? How long do you have time to complete this construction? Well, again, you asked that before we completed it. You could do possibly a construction exchange, okay? As I mentioned, with the construction exchange, we have to come in, we buy it. Completion would have to be done within 180 days, okay? That's one of the reasons I've mentioned to everybody, just wait to the very end to ask your questions, because some of the questions I answered throughout the course of the presentation, okay? Could we have your phone number and email? My seller needs it. Okay, it's on the screen. It looks like you actually asked that before we ended as well. All right. Could you help us do it? It looks like you asked that before the end of the presentation. Again, I want to be a resource for everybody. Let me know. I'd be glad to handle the 1031 exchange, answer any questions you or your clients may have. All right, Claudia, you want me to explain the depreciation recapture tax again? Depreciation recapture tax. Any depreciation that you claim for the lifetime that you own the property, when you sell that property, they hit you with a 25% tax depreciation recapture for the entire amount of depreciation you claim for the lifetime that you've owned it. All right. Okay. Ying, if you need the Chinese versions, you have a question, send you the English and Chinese, please send me an email. Once I close up the question and answers, I'm not going to have access to these question and answers anymore. Okay. All right. Sally, you're welcome. All right, so it looks like that's it. And again, if you have any additional questions, again, please send me an email, give me a call. We can talk, or we can chat via email. Again, I know it's sometimes it's hard to type in the detailed questions in a small little question and answer session like we have now. No problem. As I mentioned, I want to be a resource to everybody on the line. Okay, don't feel like you have to go about it on your own. Don't feel like you have to be a 1031 exchange expert. All right. Okay. Well, I guess we'll go ahead and wrap it up for today. And hopefully, if y'all have any other questions, feel free to reach out to me. If you want me to come in and do an individual presentation for your office, please let me know that as well. I have information I can forward on to you, and be on the lookout for those PDFs. I should be getting them out in the next few days, and the link to today's recording, that'll be coming out in the next few days as well. It has to upload and render. It'll take a little time, but it'll be on the way out in the next few days. All right. Please, everyone, stay safe, stay healthy. Thanks for joining today, and take care. Hopefully we'll talk soon. Thank you. Bye-bye.